All right. Thank you everyone for joining us today for our virtual seminar. As you know, we have these monthly webinars to provide financial education, and it's usually from the perspective of an estate planning attorney, a financial advisor, and an accountant. But today we are on part three of a business owners series. And it's going to be called How Businesses Can Minimize Tax and Save for Retirement with our guest speaker, Jeremy Yang. Just to let you know, these monthly meetings are typically presented by, of course, Sophia Sakamoto, who is an estate planning attorney with offices in Buena Park and Mission Viejo, Yuri Yu, certified public accountant with offices in Fullerton, and Donna Lee, of course, the financial advisor, and her office is located in the city of Orange. If you have any questions, please feel free to type them in the chat box below. We'll answer them at the end of the webinar, time permitting. As you may have noticed when you came into the webinar, it's being recorded. This presentation contains general information. It's not legal or tax advice. There's no attorney-client relationship. If you want to take a screenshot or use any of this material, let us know beforehand. Okay,
All
Donna.
right. Yes. Well, today we are very grateful to have Jeremy Yang with us. One, for him to impart his infinite wisdom on the world of 401ks and retirement planning, but also two, because as some of us know, October 15th is a big tax deadline, and he's got a deadline up against. So we were very grateful today for Jeremy's time. So thank you very much, Jeremy, for being here today. Jeremy Yang has been practicing in the retirement industry for 20 years. He started in the family business while in college and has worked his way up from the bottom. He currently holds a qualified 401k administrator, that's a QKA designation, and a qualified pension administrator, QPA designation from the American Society of Pension Professionals and Actuaries. He also holds an enrolled retirement plan agent, ERPA designation, allowing him to represent his clients before the IRS on retirement plan matters. On a personal note, Jeremy and his family are a foster family, having cared for and served foster youth in their home for the past 13 years. He and his wife have 3 amazing sons and reside in Placentia. Jeremy, take it away.
Thank you, guys. Thank you so much. I appreciate the opportunity to share today and to talk a little bit about retirement plans, but mainly talk about how retirement plans can help your business save on taxes and how we can use qualified plans to reduce your taxable income. So that's really what we're here to talk about is retirement plans and how they can be used. And we're going to get a little technical today and kind of dive a little bit deeper into it. But first, we want to kind of give you an overview of what retirement plans are and how they came about. We're going to talk a little bit about qualified retirement plans, the different retirement plan options, lastly, we're going to look at a qualified retirement plan design. After that, we're going to take a look at some of the laws, the Secure Act, and how the Secure Act has changed some of the rules and how that applies to you and your business. And then, of course, for our California employers, we're going to look at CalSavers and how CalSavers does or does not help you with your retirement plan or with your business in saving for your employees. So that's kind of the format that we're going to go with today. And first, we're going to look at is what are retirement plans? And so retirement plans are governed, they were established back in 1974 under ERISA. ERISA is E-R-I-S-A. It's the Employee Retirement Income Security Act of 1974. And it's what legislators did is to establish these rules in terms of how these retirement plans are going to be governed. And of course, they have updated and changed rules over the last years so that we can continue to have designs that are going to be present and really good for us as current employers. So ERISA is the federal law And really what it does is it breaks down retirement plans into two categories, And the first category is what's called defined contribution plans. Defined contribution plans. And sometimes you'll hear me call them DC plans. Those type of plans are 401k plans, as well as profit sharing plans, 401k plans and profit sharing plans. There used to be a myriad of other types of retirement plans, but these are the ones that are current, that are mainly used nowadays. The other category of retirement plans that were created, are being used now, is the category called defined benefit pension plans. Defined benefit pension plans. And there are two main types of plans that fall under this. It's the defined benefit plan itself, as well as a cash balance plan. And what we're going to do is we're going to take a little look at each one of these types of plans and how, and take some scenarios and see what an employer can do in each situation, what their deductions would be, which ones would be good for them in their current situation. And of course, what would happen, what would be good for them as they grow, or what would be good for them as they get older and closer to retirement. And so we're going to look at the defined contributions and defined benefit plans. We're going to start with defined contribution plans. So defined contribution plans is a plan that most people have an idea about. Defined contribution, essentially, what that means is that the IRS defines the contribution that can be made into the plan in that particular year. The IRS defines the contribution that can be made into the plan for that year. So for example, in a defined contribution plan like a 401k, the IRS says that for the year 2021, the IRS says that one person can, from their salary, contribute up to $19,500 from their salary. So they can contribute up to $19,500. Really, the rule is up to $19,000, the lesser of $19,500 or 100% of their salary. They can also, if they are 50 years and over that particular year, they can also contribute another $6,500 as what's called a catch-up contribution. A catch-up contribution. So total for one person who is over 50 years old in a 401k plan, they can, from their salary, contribute $26,000. Now, a lot of times, most 401k plans nowadays will offer the ability to contribute the money, both pre-tax, which is just the traditional 401k, as well as after tax, which is through a Roth salary deferral. So they can do a pre-tax $26,000 where they're not paying any taxes on that, essentially reducing their taxable income off of their W-2 or off of their compensation. Or they can pay the taxes on the $26,000, put it in as a Roth deferral, employee deferral, meaning that they pay the taxes now, and that money that they put in will then grow tax-free. So they will not have to pay taxes on that money when they take it out after they retire. So yes, salary 401k plans have that ability to be put in before and after tax. And again, most employers are offering that ability to their employees as well. So as I said, defined contribution plans, the IRS defines the contribution for that particular year, and it's $19,500 and up to $26,000. But they also define the contribution that can be made from the employer as well. So the company can also make a contribution for the employee as well. And in this situation, this is through another type of retirement plan, or it's called a profit sharing plan. A profit sharing plan. So in a profit sharing plan, the company can contribute up to the lesser of 25% of compensation, or for the year 2021, $58,000. So up to 25% of comp or $58,000. Now, this is a discretionary contribution, meaning that the company every single year can decide whether or not to make this contribution on behalf of its employees. They can decide how much of a contribution they would like to make, if it's a minimum, if it's a couple percent, or they can say, oh, we're going to do all the way up to 25%, as long as it does not exceed each employee's $58,000 limit for that particular employee. So combined together, a lot of times retirement plans, the 401k plans will have this profit sharing component as part of the plan. So they will have both components together in one plan. And in that situation, for one employee, they can contribute from their salary up to $19,500, and the company can contribute up to $38,500 as well. So a combined total of $58,000. And of course, if the employee or the participant is over or 50 years of age and over, they can contribute an extra $6,500 to get up to the maximum of $64,500 for one person. Now, so just wanted to throw it out there. Can anyone tell me what is the minimum W-2 that one person needs in order to get the maximum defined contribution amount? What is the minimum W-2 that's needed in order to get the maximum defined contribution plan amount for the year 2021? So
we're all taking out our calculators here.
sure, yeah, yeah. And I'll give you a hint. It's essentially what you're going to do is you're going to divide 25% by the 38,500. And that should get you $154,000. So if an employee is paid $154,000, a participant has a salary of $154,000, they can contribute $19,500 from their salary. And the company can also contribute 25% of their salary as a contribution. So the company will contribute the $38,500. So what's important, what's significant about this $154,000? Well, it's significant in that this is the minimum amount, but it's also the most efficient way for an employee or a participant to get to the maximum dollar amount. It's the most efficient way for a participant to get to the maximum dollar amount. And we're going to get there and talk about the other options that fall under or that are similar to defined contribution type plans. So we're going to move to the next slide now. So let's take a comparison. Let's do a quick comparison. And here are our assumptions, okay? This is an owner-only S corporation, meaning that there are no other employees that the S corporation has. This employee, this owner, is 52 years old, and he takes a salary of $154,000, the same salary we just talked about. So in that situation, we're going to compare what are the different options that this owner can do through IRAs as well as a defined contribution plan. Okay, so we're going to compare all of the options. So in the first option, and we're just going to disregard the fact that this is probably over his AGI, his adjusted gross income, and so he probably won't be able to make a traditional IRA contribution anyway, but we're just going to go through and use these numbers. So for traditional IRA, the participant could contribute from their salary a total of $7,000, and that's for the year 2021. It's $6,000 normally for anybody that's under 50 years old, but because this participant is 52 years old, it's he has a $1,000, or that person has a $1,000 catch-up, which brings it to a total of $7,000. Okay, and the next one, it's a simple IRA, a simple IRA. And a simple IRA is not very simple, really. It contains two parts. It contains the employee contribution from their salary, plus a matching contribution on top of that, a matching contribution. And the matching contribution in a simple IRA is capped as a minimum of 3%, 3% of the employee salary. So in this situation, for the year 2021, the participant can contribute $13,500 as salary deferral, and they can also do a $3,000 catch-up, so $16,500, and the company can match 3% of the W-2. So 3% of 154,000 is $4,620. So total contribution for one participant under a simple IRA is $21,120. $21,120. Now, so that's a simple IRA. And we're going to contrast that with a SEP IRA. A SEP IRA. A SEP IRA is very simple in that the calculation is strictly 25% of compensation. So whatever the participant's compensation is, in this case it's 154, the company can contribute up to 25% of compensation. In this SEP IRA, the participant cannot contribute from their own salary. It's just a company contribution. So in a SEP IRA, the company can contribute $38,500 for this participant. $38,500. Now, SEP IRA is the two SEP IRA and simple IRAs are retirement plans, are IRAs for the company that's established for the company on behalf of all the employees. And it's not considered a qualified retirement plan. The next one, which is a profit sharing plan, is considered a qualified retirement plan, which means it's subject to ERISA, right? We talked a little bit about ERISA earlier. So it's subject to ERISA. And in this situation, again, it has the same calculation as the SEP IRA. The contribution amount is up to $38,500, up to 25% of compensation, or in this situation, $38,500. Now, just as an aside, if the participant had a much higher salary, let's say $300,000 W-2, we're capped at, both in the SEP IRA as well as the profit sharing plan, it's capped at the lesser of 25% of compensation or $58,000 for the year 2021. So even though a participant may have a very large salary, $300,000, the company will not contribute more than $58,000 for that participant in either the SEP or the profit sharing, because of we're looking at the lesser number. Okay, so profit sharing $38,500, but here is the 401k profit sharing plan, and in the 401k profit sharing plan, one person at the age of 52 with $154,000 W-2, total contribution is $64,500. $64,500. 26,000 salary deferral plus the catch up in that, and then the company can contribute $38,500 for a total of $64,500. And that's why I mentioned earlier that the 401k profit sharing plan is the most efficient plan. It uses the least amount of salary to get the most amount of contribution, the least amount of salary for the maximum contribution for all of these different options. So that's kind of a quick comparison for defined contribution plans against IRAs, which can also be established for retirement plans. So DC
I love
plan
this slide, Jeremy, because it shows all the different ways that clients can save. And this is where when clients say, oh, which one should I use? It really depends on a lot of factors. So I really, really thank you for going through this.
Sure, absolutely.
I did have a quick question. Since you were talking about salaries and such, and with regards to say 401k, can someone who is not incorporated, someone who's not an S Corp or C Corp, set up a 401k?
Absolutely, that's a great question. The answer is yes. So sole proprietorships, as well as LLCs taxed as a sole proprietorship, can also set up 401k plans. In those situations, you use the Schedule C, the net Schedule C, for calculating the contribution. In terms of, so what is a net Schedule C? It's that income that you get from, the income you get from your earnings, minus out all of your expenses, and then you have a net Schedule C number. And that's the number I use to determine how much they can contribute. And so, yes, you're absolutely right, Donna. You can use, it can be a W-2, it can be a corporation, it can be sole proprietorship, all of those above. Yes, absolutely.
Thank you.
Great question. Thank you. Thank you very much. Okay, so the next slide. So we talked about ERISA, and ERISA has two categories, defined contribution. Now here's the other major category. It's the defined benefit plans, defined benefit pension plans. And defined benefit pension plans are different, mainly because they are true pension plans, meaning that they have a liability for the employer. They have a liability for the employer. Now that sounds a little scary, but let's kind of dig into it a little bit more and and understand more what it means. So a liability for the employer essentially means in this situation that the assets that the employee that receives as contribution is guaranteed, is a liability for the employer, meaning that if the employer is giving $1,000 as a contribution for the participant in the plan, when they retire, they have to have that $1,000 plus interest at retirement for that participant. So there is a requirement that they have to have that. But the flip side of that is that the defined benefit plan, the IRS does not define the amount that can be contributed in that year. It doesn't have a limit in terms of how much can be contributed in that year. Rather, the IRS defines the benefit one participant can have at retirement, defines the benefit one participant can have at retirement. What the IRS is saying right now is that at age 62, your normal retirement age for calculation purposes, the IRS says that one participant can withdraw up to $230,000 per year for their lifetime. $230,000 per year for their lifetime. That's their Internal Revenue Code 415B. It is updated, it's indexed. It goes along with, last year, 2020, it was 230,000. I think the year 2019 it was 225,000. And of course, we expect it to increase for the year 2022. So the IRS defines that amount. Essentially, at age 62, you could conceivably withdraw 230,000 that year. At age 63, you could withdraw 230,000 and every single year ongoing until they retire, until the mortality table says that the person passes away. So every year, $230,000. Now, this is great because what you have to do is when you discount all of those distributions, 230,000 each year back to age 62, you need to have a lump sum amount of money. And that lump sum amount of money at age 62 is approximately $2.9 million. It's approximately $2.9 million. So when you have people who are employers who are older and closer to retirement, and they have a shorter time period to contribute into the plan, they need to contribute a much larger amount of money in order to have the 2.9 million at retirement. So for example, if somebody is 50 years old and they have 12 years until retirement, and they have the maximum salary, they can justify the 230,000 per year, they're probably putting in at least 150,000 per year into a defined benefit plan for themselves, right? So because of that short period of time. Now, if somebody is 30 years old and they have 32 years until retirement, they're not going to be putting in as much money. That amount is going to be significantly less because of time. They have many more years until retirement, and because of compound interest. Compound interest will help them get to that maximum amount and has to be accounted for in the calculations. So defined benefit plans, great for employers who are older and have less time until retirement. It's not so good for employers that are young and have many more years until retirement. And of course, it uses compound interest to help it get there. So defined benefit plans. Now, cash balance plans are a type of defined benefit plan. It's similar in calculations to a defined benefit plan. But what's the main difference? The main difference is that in a cash balance plan, the way it's presented to employees is a lot easier for people to understand. In a defined benefit plan, the way the contribution or the way the employee sees their personal statement is that at the end, they see a personal statement that says a monthly accrued benefit, a monthly accrued benefit. And you can think of it as like a Social Security payment, right? So Social Security, they don't tell you how much you've actually accrued or how much you've actually accumulated inside of Social Security. What they tell you is that at age 65 or whatever it is, you can have a distribution or a monthly payment from Social Security of $1,500, right? And if you wait till 67, it could be $1,700, whatever, that's the monthly distribution that they receive. In a defined benefit plan, the participant also sees a similar number, a similar presentation, they also see a monthly accrued benefit, which doesn't really help the participant understand how much they actually have in dollar figures inside of the plan. Now, in a cash balance plan, this was addressed. So instead of seeing a monthly accrued benefit, they actually see the amount that was contributed on their behalf. So if the employer contributes $50,000 for this participant, and then they had a 5% interest credit, then at the end of the year, that participant now has a $52,500 balance at the end of the year. And so for a lot of participants, it's easier for them to understand how much they actually have accumulated in a defined benefit or cash balance type plan when the presentation is given like that. So again, calculations are pretty similar. It's just the presentation that varies, but it does help in a lot of ways, particularly for employers that have partners, employers where there are multiple employers who own the business. It's nice to be able to see your particular amount that you've accumulated in there, not a projected monthly benefit at retirement. So as I said before, defined benefit plans, great for participants, owners who are in the plan, who are older and closer to retirement, that have large salaries as well. If you are an owner with a smaller salary, it's not so good. My recommendation at that point would be to take a little bit more, either in W-2 or if you're Schedule C, not take as many deductions so that you can have a larger compensation to calculate your contribution. Now, the thing to remember about a defined benefit plan is that for employees who do not have a high salary, even though they might be a little bit older, they won't justify the $230,000 distribution if somebody's only making $35,000 a year. So the $230,000 really requires a compensation somewhere around $240,000, $250,000 for 3 consecutive years. The $230,000 distribution at retirement requires around $240,000 to $250,000 W-2 or compensation now to be able to calculate that amount. Okay, so that's what you want to look for. Is you want to look at the owners, and you want to see if where are you at in terms of relation to the normal retirement age. Okay, so let's talk a little bit about a proposal. So this is a proposal that I created for one of my clients. It's a dental practice, and this dentist has 5 participants. He has a couple other employees who are currently not eligible, but these are the 5 participants in the company that are eligible. And if you will notice on the left-hand side, the owner and the owner's spouse are both taking salaries from the company. The owner is 56, the owner's spouse is 52, and the owner is taking a pretty large salary. Actually, it's over $290,000, but the IRS limits how much salary we can use for calculation purposes to $290,000 for the year 2021. And the owner's spouse is taking $85,000 as a W-2. The owner also has 3 employees that are eligible. These participants are a manager and 2 employees. The manager is 54 years old, so very similar in age to the owners. And the 2 employees are in their 20s, 26 years old and 24 years old. So this kind of sets the stage, right? So we talk about defined benefit plans being beneficial to older owners, which is where this is going to come in, but it also is kind of costly if you have an older employee. And so how do we get around, how do we calculate to be able to reduce taxable income, but also contribute as much money as possible to the owners? So that's the predicament that we're in. Now, the W-2 income is shown on the next column. $290,000 for the owner, $85,000 for the owner's spouse, $36,000, $32,000, and $22,000 for the 3 employees. And then the next column after that is the defined benefit plan. So the defined benefit plan. And essentially what we did here is we did not separate out the owner's portion, but in total, the defined benefit contribution will be $280,000 from the company. So this company deduction, the company will be able to reduce their taxable income by $280,000. And so the employee's portion, it totals out to be just $2,000 in the defined benefit plan. which means that the two owners combined are going to receive about $278,000 for themselves. Now, on the face of it, when we look at just this plan, we can tell that we're using two different formulas in the design. We're using a maximum formula for the owners, where they can contribute them, where the contribution is going to be calculated at the maximum amount. And then we're using a minimum formula for the employees. The minimum formula in retirement speak is called a meaningful benefit. And so we're using two different formulas, which in and of itself is going to be discriminating against employees, right? Discriminating against the non-owners. So we can't, because of the discrimination, we can't do this plan by itself. We cannot do this plan by itself using this plan design. What we have to do is we actually have to add in a 401k plan, a 401k profit sharing plan, to be able to contribute on behalf of the employees in order to pass non-discrimination testing. So we add in the second plan, the 401k profit sharing plan. Now in the 401k profit sharing plan, we have different components. And the first component is the employee deferral. The employees, the participants, can contribute from their salary. Now, back to the second slide that we had talked about, in a 401k plan, employees can contribute up to $26,000 from their salary if they are over 50 years old, which the two owners are. So the two owners are contributing $26,000 each. Now, the employee contribution, it doesn't, in this situation, it doesn't particularly matter. It doesn't matter in terms of the plan design. If the employees decide they want to contribute, $50 a pay for each payroll period, or they want to contribute $0, it doesn't make a difference to the design of the plan. So in this situation, we're leaving it blank. So in total, the two owners are going to contribute 26 each, which is a total of $52,000. And now here is where the contribution is going to be given from the company to the employees in order to pass non-discrimination testing. That's through the employer contribution, or the profit sharing contribution of the 401k plan. So in the profit sharing contribution, we've tested that the company has to give 7.5% as a company contribution to the employees in order to pass non-discrimination testing. So in order to receive for the employers to receive the 280 in the defined benefit plan, the company needs to give 7.5% as a company contribution for each one of the employees. Now, that still seems a little bit discriminating, right? So why is that? Why is it that works as the amount needed to pass non-discrimination testing? And the reason why it works is because of compound interest. Albert Einstein has been known to say that the eighth wonder of the world is compound interest. And compound interest, what it does is it allows the amount that you're contributing to grow until retirement and to become a much larger amount at retirement. So even though you're contributing $2,400 for employee one, that amount is going to become a much larger amount at retirement because of compound interest, because of the fact that employee one is only 26 years old and they have 36 years until retirement. Compound interest is going to help that amount to grow. Same thing with employee two. Now the manager, because the manager is older, has less time, but in totality, in looking at the entire pool of money for the employees, it's going to, it allows it to pass. It doesn't mean that everybody has to pass. It just means that, most of the employees have to be able to pass on the owner's contribution. So in total, the 401k plan is going to have a total contribution of $77,800. When you combine the defined benefit as well as the 401k plans together, the two plans together is going to be $357,800. Now, we don't just look at this large amount and tell that number to the client. We want to break it down for the client. We want to break it down for you as an employer and try to help you understand it better so that you can figure out if it makes sense to you, for you as a tax savings vehicle. So the first thing we look at on the bottom left is called the benefit breakdown. The benefit breakdown. And essentially what we did was we took each portion and broke it out into the employer, the owner's portion versus the employee's portion. And we want to see for every dollar that goes into the plan, how much of that dollar is split between the owner's portion and how much of it goes to the employees. How much of it goes to the owners and how much of it goes to the employees. In this situation, for every dollar that goes in, about 97.5 cents or 97.5% goes to the owners, and about 2.5 cents or 2.5% goes to the employees. Now, of course, I'm going to use a very good example, but most CPAs, most accountants who have dealt with retirement plans like this want to see a number that's higher than 70%. So they feel that if it's over 70%, yes, it makes sense to use a retirement plan. But if it's under 70%, if only 65% goes to the owners and 35% goes to the employees, then it's better to just pay the taxes because you're not getting enough of a tax benefit, okay? So that's the first number that we want to look at. The other number that we want to look at is on the bottom right. And on the bottom right, what we're looking at is what's called the summary after taxes. The summary after taxes. So what happens if we don't use this plan? An employer will then have to pay taxes on $357,000. And at a 45% tax rate, I understand, I'm simplifying the taxes, but I understand marginal tax rate, but we're simplifying it for this particular example. But at a 45% tax rate, if the employer were to pay taxes on $357,000, they would pay $161,000 in taxes to the IRS, to the government, and they'll never see that money again. They will only walk away with $196,000 for themselves. So they pay taxes on $357,000, but they would get to keep only $197,000. Now considering that amount, we want to look at how much is going to be deposited to the owners when we use this plan design, because we know that we have to give money to the employees. So we're not going to consider that because that's not really going to help us. But how much is it going to be for the owners? And in that situation, it's $349,000 goes to the owners, which means that in this scenario, the employer is going to save $152,000 by using this plan design. So they're going to save about $152,000 in taxes by using this plan design. Okay, so let's move on to the next one. So we took a look at all the retirement plans. We took a look at the scenarios. We took a look at defined contribution versus defined benefit, as well as a situation for the employer, a scenario for them. Let's talk briefly about Secure Act. The Secure Act, which was signed back in December of 2019, changed quite a bit of rules for employers who currently have retirement plans or who are thinking about it. One of the main ones is the required minimum distribution. It used to be that employers who had a retirement plan or participants who have outside money in IRAs have to take required minimum distribution starting at age 70.5. Now the age has been moved up to 72, and there's talk in the future, maybe in Secure Act 2.0, that they might move that number up to 74 or 75 years old. The next thing that has actually helped a lot of employers is that if you start a new 401k or qualified retirement plan, you're going to receive an increased credit for small plan startup costs. So increased credit for small plan startup costs, it used to be much lower. Now it's a little more complicated to calculate, but in general, it's a lot higher for people who are starting up a retirement plan. The next one is the long-term part-time employees, LTPT, long-term part-time employees. So this is one way for employers, for the government to help incentivize employees to receive money or to be able to put money into retirement plans as well. It's used to be that if you did not work over 1,000 hours in a given year, you weren't able to contribute, you weren't able to participate in a 401k plan using statutory eligibility. The IRS has changed that now. They've allowed employees who are long-term, meaning that they've worked for the company for at least 3 years, and they've worked at least 500 hours in those 3 years consecutively to become participants in the plan. It doesn't mean that the company needs to contribute on their behalf. It just means that the company needs to allow these long-term part-time employees to contribute salary deferral into the plan. The next big one is the extension of the due date for adopting a qualified plan. So before in the past, you had to adopt the plan during the plan year, but now the IRS has changed the rules that you can adopt a plan after the plan year up until the point where you have to file your company's tax returns. So you have until after that to do that. And then lastly, they've increased the Form 5500, which is the pension tax return penalties. So it used to be $25 a day. Now it's $250 a day. They've basically 10 times the penalty. So that's the Secure Act. Today, we don't actually have time to get into CalSavers, but if you are a California employer, essentially, if you have over 5 employees, you need to have be in some sort of CalSavers program or in a qualified retirement plan or a simple SEP IRA. So that's all my time for today. Thank you guys so much for that. Yeah, appreciate it.
Thank you so much, Jeremy. That was a lot of information packed in 45 minutes. It's definitely one of the webinars that would be helpful to go back into and review, especially some of the numbers. So we will be recording this and it will be posted on the website soon. Sophia, do we have any questions?
No, not at this time. So just want to thank you all for attending. As you know, this is part 3 of 3 geared toward business owners, and a lot of helpful information for employers to really think about how they can minimize tax and save for retirement. Want to say a special thank you to Jeremy Yang. You just saw his information in the slide right before this one. So if you have any questions, of course, let him know. We know your time is precious and we strive to provide content that is informative and useful. If you missed last month's seminar, we had business mistakes business owners make with Garam Kang, and we also had employers in COVID with Sanjay Sabharwal. Please visit our YouTube channel for all past webinars. In November, we're having a year-end planning and summarizing the tax changes webinar, so please be sure to sign up for that. Be sure to register through the webinars with the link right here. And again, thank you everyone for attending. A short survey is going to be sent out to you. We appreciate your feedback. Thanks everyone. Have a good rest of your day.